Well, good afternoon, everybody, and welcome to the Tuesday, May 25th edition of Bull Sessions. My name is Mark Robertson. I'm joined here by Ken Cavola. Good afternoon, Ken.
Good afternoon, Mark.
In
Not as pretty a day as it's been recently, but we're kind of blowing up here. How about down there where you are?
It's a little blustery. We can use a little bit of precipitation, to help with the spring greening up. So we welcome that. All right, so in keeping with our traditions, we do have a roundtable tonight, as you guys know, so we'll try to keep things fairly brief and to the point this afternoon. And as part of our program today, we'll go back and look at our actions taken 4 years ago at the roundtable back in May 2017. Our main theme for today is going to be a look at, some of you will recognize the borrowed Ready Kilowatt logo or icon there on the left. We're going to take a look at a really interesting concept that I was exposed to by Ken Janke. He was the president and chair of NAIC he was with the NAIC, National Association of Investors, since 1960, and ultimately was my boss at the organization. And just a way that he convinced people to get involved in investing by allowing your stock holdings to pay your utility bills. And it's really kind of a neat exercise to go through. At least I hope you think it'll be neat. And we'll take a closer look at it. Hence the golden cow. If you can own the cow and the cow pays the bills, it's a good thing. The picture on the right is me with my grandson, and just a tribute to things that grandsons can teach their grandparents. So let's go ahead and get underway.
Start by teaching you to wear long pants on a slide,
Just take it easy there, big guy. Says, hey, Grandpa, we got this.
I'm just thinking of the noise going down, that's all.
Oh, man, you're probably right. All right, the legal paperwork, just to be quick and complete. No investment recommendation is intended. We are actually going to name some stocks today. This is all about education and demonstration, illustration of the techniques, methods, philosophies, and beliefs of the modern investment club movement as we interpret them and suggest them at Manifest Investing. That's true for the National Association of Investors and Better Investing also. Anything that you hear from us is our opinion. We do try to remember to tell you if we own something we're talking about. We have that monthly roundtable webcast tonight. If you have not checked in on one of those, you're invited to. They're wide open. They're free. You get some your favorite comfortable attire, your favorite beverages. Kick back, and 3 or 4 of us will share an idea along with the analysis of why that idea might be worth digging into a little bit deeper. If you'd like to be reminded about those monthly events and other educational events that we do online, send an email to ncavula1@comcast.net. If you'd like copies of these slides, or if you have follow-up questions, or even more importantly, suggestions for future Bull Sessions topics, and we actually have 2 or 3 brand new ones that came in over the last few days, send an email to markr@manifestinvesting.com. We'll chew on it and try to figure out how we can get that in front of everybody. Any comments or questions, Ken?
Nope. Ready to go.
Well, here's our bullpen. Again, that's our storage locker of future topics, along with what we are going to talk about today. Again, we're going to come back to Ready Kilowatt there and the utility of investing. We'll go back and take a look at that retrospective, the stuff that we chose 4 years ago. And Ken, you're going to be happy with where we end up on that journey. Hint, hint. We were asked by a number of people about that buy zone, buy, hold, and sell zone chart that we put out at the conference last week. Again, thanks, Ken, for the opportunity and everything you put into that conference too. Organizing, it's definitely like herding cats. I think that's a gentle way of putting it, right?
Well, I felt that we did a really nice job squeezing 2 hours of material into 2 hours. So it was.
I don't know if the audience can actually chime in with comments on this, but I went back and listened to it, and I felt more anxious about it during the session because I thought we were running so long and people would probably be getting tired. And I mean, one of the joys is, you go back and listen to it again, or even just look through the slides. There's a lot of good stuff there. And you can, one of the benefits of the recording is you can stop and go or go to certain parts. And
it points to the difference in the audiences and the various kinds of webinars as well. Usually on a national webinar, we would have lost 60% of our audience after the first hour. We lost only about 12% of the audience even at the end of the second hour. So thanks for staying with us, folks, and wait until Mark and I had a chance to give our picks at the at the panel, that last panel. Yeah,
I am pleased to report that we are 2 percentage points ahead of the market on the picks that were made, and we spent some time talking about that last week. So you can go back to either the notes or the recording from last week's bull session if you want to know the exact pieces. But tip of the hat to Matt Spielman because Sophie is up about 30% more than the market right now, Ken.
Oh dear, that's the SPAC one, right?
That's right. It's a runaway leader. So anyhow, yeah, it's an awfully strong start by Matt. All right, so here's some other topics that we'll be talking about in weeks to come, and looking forward to doing that. All right, well, Ken, I got out our graph that we like to tear into from time to time as our graph for the week. And this, many of you have seen this before, but just to quickly look at, we're looking at nearly 20 years of profitability. It's the average profitability for the industrial companies in the Value Line Standard Edition. So what we have done is we have set aside asset-based companies like insurance companies and banks. And so we're looking at the remainder, which ends up being about, I believe, 1,200 companies. And we're looking at their average profitability over time. And 2020 did turn out to be a challenge. It didn't turn out to be quite as big of a challenge as the experts expected early on. But it did end up down fairly low compared to 2008. And but if you look back to just a year ago, if you look here, this is from a year ago, plus a month, they were looking for much lower numbers. So they're basically the pendulum of expectations swinging way too low, way down here. Didn't happen. And the recovery that they're expecting now is pretty robust. And I'd be surprised to see all of this happen, but some of it could. And it's certainly the potential and the propensity for that to happen is a good reason to be invested in good companies at good prices. But again, the flip-flop here from almost a downward looking expectation on the long-term trend, according to this blue line, to back to where we were and perhaps then some. So what a difference a year makes.
Do note, everybody, the change in scale between the two graphs. That 2025 line is actually up a full percent, even though on first glance it looks like it might be identical.
Yes.
On a more careful glance, it's up a whole percent in that 11-month period.
And it had been down, and so again, we have the situation where a year ago, and we kind of bellyached about this, so we're not going to go into that too much detail, but again, the opportunities are created by the analysts expecting doomsday, or on the opposite end, nirvana. And this is the condition that we're in right now, but there's a lot of potential strength going forward, no doubt about it, even if that we don't quite get to the level shown on the upper right of this chart. All right, anything else you'd like to add, Ken?
Well, except that I noticed that I'm comparing apples to something that's not quite an apple. That's a 2024 graph at the far side of the smaller graph and a 2025 bar at the small side of the larger graph. So
True. That's
yeah, they are. So they are showing growth again of 1% between the two. It's awfully difficult to compare the two, but the point that you've been making with the pendulum swinging in both directions is entirely evident from what's going on here right now.
mm-hmm. Yeah, that graph on the far right is the average of the value line 3 to 5 year forecast. So that's why it's shifted here.
Yeah.
All right, let's keep crunching on. All right, again, something we probably won't do every week, but when we have a new leader, we promised we would do it. Joe O'Brien has reassumed the lead, taking it away from David Einhorn, who had dropped from 3rd to 17th back to 1st. Now he's in 2nd. Buffett is still in the top 5. Many familiar names up at the top. Yes, Ken is still on the list. Where are you?
Mark, is Einhorn riding a single stock onto this, or is it the whole combination of his portfolio?
It's the green light stock price, basically. So it's all, it's a collection of stocks.
Okay, so this is just a mutual fund or an ETF that he's riding here then, right?
Yeah, it's actually a publicly traded company.
Okay, got it.
Yep. And congratulations on number 8 and number 9, Ken. Those are 2 of your favorite places to hang out.
It's amazing that here we are about, 4 months into the contest, and we still have entries in the top 10. I'm going to take it.
Yeah, and you're on the chart still. You're here somewhere. Oh, you dropped down to 33rd.
Uh-huh.
I have a story to tell, as I often do. I'm sitting there working on this yesterday morning, and lo and behold, my name is in the 40 slot. And I figure, well, how much harm could it do to do a recalc? Kind of like when you're out there and the GPS says, recalculating the route. So I figure, what the heck? I'll go ahead and I'll hit that F9 button. And, what's the worst thing that could happen?
You could fall off the list. Yeah.
I fell off the list. I think I'm 50th now. But I should have just done the screen capture and got my name in there at 40, but I did a recalc. All right, so the average is 2%. The market's actually chunking away at about 8% right now. Only 30% of us are beating the market. I'm actually right at the market. We typically see that number much higher. We talk about 60 to 80% in typical years, so let's hope that everybody finishes strong. And as we were just saying, those disruptive companies that are represented by Kathy Wood's selections rank 142nd out of 144, so the high-tech disruptive companies have been really challenged, and my thinking is that can represent opportunity. If you can find the ones that really have a good long-term outlook that have simply been beaten down for some time.
Mark, is there a larger presence of clubs in this top 40 than normal?
Yes. That typically we would have, I want to say 4 to 6 maximum in the top 40, and you can see there's more than that here. And there are several just off the list. So the clubs are having a good year. It reminds me of a year, I want to say 3 or 4 years ago, when we had a very strong club showing. In fact, that was the subject of our feature that year. All right, very familiar names. Tip of the hat to all of you. Good luck. I do plan on joining you on this list. All right, so let's talk about 4 years ago. You remember these days, Ken?
I certainly do, Mark. Is that Cincinnati? Is that what I'm looking at?
Pretty sure that's Cincinnati, and we were at, I believe, the Marriott across the road for one convention, and then downtown at a hotel in the heart of Cincinnati a few years later, right?
Right. We were actually in the Cincinnati area 3 times within a relatively short period of time. It was a nice place to run a conference, an easy place, and we had good attendance at those conventions as well.
No, I think it's a great place, and look forward to coming back there soon for a chapter event or a national event again someday, perhaps. But good stuff. This is just our reminder that generally in May, when we've had a national convention for the National Association, we've done our roundtables live in person, often having a a second follow-up presentation. That's where that could be slightly confusing. We did the in-person presentation on the 19th, and then we did have a webcast on the 30th here. So just wanted to remind everybody that that has been kind of a tradition at the National Convention. This was the convention lineup. You can see the selections that were made by Ken and Kim and Cy, and I selected CVS. So that was the stuff chosen. And here's how those have been basically done. What you're looking at here is our spreadsheet log of the companies. And of the 4 selections, Dollar General was selected by the audience, so it's represented there. Dollar General is represented twice. 3 of the positions have been sold. That's the yellowed out fields. And you can see the dates that they were actually sold and how well they did. And Dollar General did quite nicely. So Ken's pick of Dollar General and the audience's second actually did very well over that time frame of that looks to be a little over 2 years, with a relative return beating the market by 30 percentage points. Starbucks didn't do quite as well, but there's more to that story. We'll get into that. And of course, CVS Health decided to, I guess, morph might be the best way to describe what happened with that company, and it became a different company during that time frame, and I think it really confused investors. It might be a good one going forward, but it certainly was in a holding pattern from a stock price standpoint for quite a while. And of course, the 4th selection was Kim's LGI Homes, which is still in the Roundtable tracking portfolio, and it's contributing very nicely. The $1,000 invested in that back in May 2017 is worth over $5,000 today. So that one is beating the market by 34 percentage points, checking it at a 50% annualized rate of return.
Mark, this was about the time that we started looking at our timeout idea as well, isn't it?
It is. It's. I don't remember if we applied any of that directly at that conference, but we definitely were talking about it, and we did some sessions on better selling at that conference.
Because I'm looking at Starbucks, and it was sold just a little bit more than a year after it was purchased at a pretty low relative return. I'm wondering if that was one of the early ones that we applied that rule to.
I think so. I think we'll look at it here in a second. Here's a look at one we haven't had to sell or didn't have to sell. This is from Stock Charts. You can actually do what's called a performance chart, where you enter the ticker and then a comma and whatever benchmark you'd like to benchmark against. I just use VTI for the Vanguard Total Market. And you can see that, Ken, your selection of Dollar General never looked back. Pretty good run there during the period which it was held. So that's a lot of good clean fun for sure.
Well, and I know when we sold this, Mark, that Dollar General had kind of moved itself to a par that was a really low par. In fact, that was probably the reason that it was pushed out of the portfolio, because we were trying to raise par. But
it went from here to here in a hurry.
Yeah, the story for Dollar General continued, though, up into the current time. It still is a ship that is moving in an upward direction. So a very interesting stock, to say the least. Mark, did you hear the statistic that almost 80% of the new retail space that was built in the last calendar year was built by one of the dollar stores?
I hadn't heard that, but I believe it. I just returned from Illinois and took some of the back roads through northern Indiana and southwestern Michigan, and I bet you we went by a dozen Dollar Generals, and half of them weren't there a couple years ago.
Yeah, they were indicating that that's one area of the market where the building has not slowed, where the stores continue to go up. I don't know how familiar a lot of our audience is with I-75 from Michigan to Knoxville, Tennessee, but you go up a mountain when you're going south, right at the border of Kentucky into Tennessee called Jellicoe Mountain. And Jellicoe Mountain has added a couple of new exits on this upward, very steep upward road. And at both of the exits, in the middle of nowhere as it appears, although there must be people that live there, but as far as the road's concerned, in the middle of nowhere, there's Dollar General stores at both of these new exits. So, very
kind of the same thing with relatively smaller towns in the south, right along the Indiana-Michigan border that I'd not seen before.
Yeah.
All right, here's a quick look at two of them that didn't work out quite so well, but as Ken was saying, the red one is Starbucks, and we probably did exit that one right at that point that's shown on the left here, at a point where it was trailing the market by 20%. It was on a pretty significant downward trend. Now, we have actually gone back into Starbucks, probably somewhere over here. I could dig it out and look it up, but we actually have a pretty well-performing Starbucks position. And I like to point out that throughout this entire period, that's what some of the lines waiting for coffee look like around the country. So Starbucks does persist. The green one, which has not kept up with the market very well, is CVS. And again, CVS is going through an evolution or a mutation, whatever you want to call it. They are changing as a company. They may come out the other side just fine, but I do think investors have generally been relatively confused. And you see the green line hasn't kept up with the blue line for the market for quite some time. And most technicians would point out that that's a multi-year trading range. I tend to think of a multi-year trading range or a flat spot as one heck of a potential opportunity if the underlying company is continuing to fire on all cylinders. So it's a kind of an interesting thing to watch. Notice that on the far right-hand side that CVS has been making some pretty decent moves here. And they did serve up some vaccine for me, so they served me pretty well here recently. Any thoughts, Ken?
I was just going to point out the breakout that has occurred with CVS. If a lot of the investors in the country are like I am, I'm having a hard time deciding what kind of company CVS even is. I mean, is it an insurance company? Is it a medical company? What does it want to be? Where does it want to proceed? I also had my inoculation done at a CVS store, but I watched the manager of that store run around like his hair was on fire because he was receiving all kinds of direction from his home office as well as the county health department. And a lot of it was just all directly opposed to each other. He was getting conflicting messages constantly. And at one point they were telling him to clear his store because he had too many people inside the store. And then they're sending him large groups of people to be inoculated at the same time, where the inoculation occurs at the back of the store where there's no door. So a lot of problems were going on, and I think that CVS has to figure out who's going to be in charge and what do they want to be before it finally moves in a direction that I'd be willing to move back into investing in the company.
Yeah, I agree with Sai's presentation from a couple of years ago. A lot of potential, but it's also a bit of a minefield can be kind of treacherous. I mean, look what's happened to it in the last year. Even with the people basically staying at home and shopping online, etc. All right, and one last one to look at. Did I go the wrong way? I think I did. Okay, LGI. LGI Homes, of course, is benefiting from the housing boom, and that's something that Ken and Kim have both been right on top of with some of the selections made over the last couple of years, and they're all performing very well for the Roundtable portfolio. But looking back 4 years, it's a pretty good run for the company. I do like to point out here in this, there's a couple times here towards the end of 2018, notice the weakness there, and then look when that weakness set in the first quarter of last year. This company is typical of a company that just gets hammered when that type of economic disruption settles in. But boy, look how they've come out of it. And one other comment, we have talked in the last few sessions about taking these three numbers and adding them up and comparing the sum to 225. In other words, 51 plus 66 plus 60, which would be 177. 177 being less than 225 suggests that this is a non-core company. And that's why it's actually in the Roundtable non-core portfolio. All right. Anything else, Ken?
Nope. I have, Mark, at various times in the last 8 weeks, compared these charts for 6 or 8 of the home builders. LGI had a deeper dive there in 2020 than a lot of them did. And why, I don't know, but its graph was atypical when you compare it to a number of the larger home builders. LGI is a fairly small company compared to a DHI or an MOH or some of these other big companies. So it was a little bit more volatile, especially during that particular period. The late 2018 period, that's kind of comparable company to company, but that period in early 2019 is not seen on a lot of the home builder charts.
Yeah, it's just fascinating to see that inventory deficit steadily being restored. It's something else, and the price of lumber and everything else. All right, so with that, I think we'll move to our next topic, and that has to do with this notion of owning a portfolio which pays your bills. And just like the picture, it takes me back to at least a few moments of my childhood and some time spent with Grandpa in the barn. And I actually have milked the cow and fed the cats, as shown in that picture. So I don't know if you knew that about me, Ken, but there you go. It's a fascinating moment. So I figured with the cow fitting with the bull theme, we would just roll with that as we go. But again, the things that grandparents can mean to us. So here's basically the premise I want to kick around here, and Ken, interrupt me if there's something we need to cover in greater detail. But what we're going to talk about is this notion of building a portfolio which basically pays your bills. And the reason I bring this up is Ken Janke actually used this to convince his father. You can go back to this picture and think of Ken's father as a very conservative. He had been through the Depression. He had seen the stock market disasters that happened. Highly skeptical, very reluctant about the stock market. And, here Ken is working for a stock investment club umbrella organization. And Ken is trying to figure out how does he get Dad to at least take a chance and experience some of the potential that's possible as a long-term investor. So he came up with the idea of, well, let's figure out what Dad pays in utility bills. And for this one, we're going to actually take a look at this one and use $110 a month, because that seems to be a fairly typical average month. We could actually figure out what each one of these months are, but it seems to be a pretty good average amount. So we're going to actually use that for our demonstration of $110 a month and basically call it a monthly payment plan like most utilities have anyhow. All right. So what I thought we would do is take a look at utilities with good yields that would actually provide that cash flow in the form of dividends to make those monthly payments. So what I did is I grabbed the stock search at Manifest, and I said, just show me the utilities. Just show me the utilities. And then I sorted them from highest quality to lower quality. So you've got the highest quality at the top of this chart, as shown here. And there's a lot of names that we're all very familiar with on this list. I X'd out Atmos because Their earnings per share stability showed a little bit of instability. And since dividends come from earnings, I figured let's just leave them out. Don't want to have to worry about the dividend disappearing if it's going to be writing the checks for us. And then I just noticed a few other things. Next Era is the old Florida Power and Light. It's actually a company that's fairly well known for some of their more forward thinking in the areas of renewable and green energy also. So that can be a very appealing thing. And they have the highest quality rating. Essential Utilities is a water and gas utility, but it has a fairly high projected annual return. Again, these are fairly decent yields. And then dropping down and looking for the company with the highest projected annual return, that happens to be Oklahoma Gas and Electric, OGE Energy, one of the best utilities I ever worked with when I was in the field as an engineer. Very decent yield, very compelling PE ratio. And then I just tacked on a couple others that had decent yields, and looking for a good utility that's diversified. Could have used Elite, but just basically picking out 5 companies to build a dividend, an average dividend yield for taking care of this bill. Any thoughts on the list, Ken?
Mark, this list is truncated, right? You've just stuck with the highest quality companies from the list of utilities. Is that right?
You could go further down. Yep, it is truncated.
Okay. All right.
There's more of the sort. One of the reasons I like to stick to the top is the farther you go down that list, the more vulnerable your dividend would be to being interrupted or discontinued. So I was trying to stick to the companies that are a little more vanilla, a lot more consistent, if that makes sense to you.
Yep, absolutely.
So
well, and we're focused on quality again, so that's good.
Yeah, and this is the whole premise behind what Ken was trying to do for his dad is, you basically set this aside and you literally forget about it. Not really, but again, you're just setting that aside and letting it take care of things. You're going to obviously monitor it, but not worry about it whatsoever. All right, so here's the situation. $110 a month for the monthly plan. That means we have to come up with that amount in annual dividends. The 5 stocks that we selected, again, with high quality and good earnings stability, had an average yield of 3.6. And we're going to apply a slight correction factor because we want to account for all the costs here. We'll assume that there is an effective tax rate, so that means that only 80% of this is actually going to be counted on for income. So we end up with an effective dividend yield after tax of 2.9%. Okay? So the amount that you're going to have invested with these 5 companies is going to be that monthly amount, this annual amount divided by this effective dividend rate to give you this amount. Now, I know for many people in the audience, so especially younger people, that seems like a lot of money, but I work with a lot of investors that's, a type of nest egg that they could set aside. Could have done it with my parents, could have done it with my in-laws. It's not an impossible amount of money to set aside into a fairly stable investment, which will achieve this purpose. And we're going to put in an extra $330 just to make sure that the first quarter is okay while the dividends are getting underway. Any comments or questions on that, Ken?
Nope, arithmetic makes perfect sense so far, Mark.
Okay, so then I just grabbed a worksheet, stuck the 5 utilities. We're basically looking at approximately $9,100 into each of the 5 utilities. So here are the share counts that were actually inputted, and came up with a number that was in that $45,000 range with $330 in cash to get started. And basically started up a portfolio on Yahoo that we'll actually watch. It's a strong portfolio. The PE is not out of range. Growth rate's actually strong for a utility portfolio. The stability of the earnings is strong. So again, no surprises here. We're looking at a fairly decent projected yield. And here are the actual dates. In fact, there's one coming up. This next era will roll over to June here shortly. So this was actually an accident. You could actually make that part of your selection process if you wanted to phase these in and have them spread out, but these happen to be spread out pretty well, that they'll just be clicking along and adding to this portfolio in those dividend amounts. So the dashboard, if you want to follow along, the public link is right there. And we're going to actually roll this thing out and watch it work. Any comments or questions, Ken?
No, it's an interesting exercise. Mark, would you do any rethinking at any point about the two that have the lowest projected yields?
Well, one of the things that I thought about, Ken, because keep in mind that back in the time when Ken was doing this with his dad, he was looking at yields that were like 6 to 8%. So the number was less ominous. I think he was looking at $25, maybe $30,000 back in that time frame. So you could actually try to juice that up with a little more yield, but you wouldn't want to get too carried away doing that. And you may have a situation where you might want to swap out one company for another, for sure.
If you were going to swap it out, Mark, would you swap it out at about the dollar value that you were selling out of, or would you try to bring it back up to roughly 20% of the portfolio?
I think what I don't know. We'll see what happens. A portfolio like this actually is designed to have more than it needs. And what I mean by that is you're going to be able to actually whittle this thing down over a period of years. You probably, much like we have done with 10 Cup or not 10 Cup, the Roundtable tracking portfolio, you could actually reach the point where you whittle down and pair these as they actually do appreciate some, to where you're basically taking back some of that 45,000 in addition to it still taking care of the bills. So yeah, it's going to be a function of what is needed to continue to fund that monthly payment.
Well, Mark, I'm going to follow it up with a practical question. Do you put this on autopilot like you suggested, or do you say to yourself, I'm going to look to rebalance it once a year or once every 2 years or something like that? Electric bills don't stay static. They do move, usually in an upward direction. The use of electricity doesn't stay static. When my son was here for about 3 months doing all of his laundry and eating food and everything, that really changed our electric bill. So I'm just wondering if there's a built-in rebalance to the whole process.
I think it's probably worth taking a look at an annual basis just to make sure it's okay.
Make sure you're still on track. Okay.
Yeah, to make sure you're on track. And I can certainly sympathize, with a college graduate who comes home every once in a while, what that can do to your electric bill. It's, again, it could be needs driven or it could be opportunity driven. If we say, for example, if OGE actually does have an extra price appreciation compared to the other components in the portfolio, so maybe you take advantage of that.
Okay.
So yeah, I think it'll be kind of fun to watch. So we're going to actually watch it as a portfolio.
So it's dynamic, but it's not nearly as dynamic as a traditional portfolio.
Yeah, and what Ken did with his dad is I recall he bought some DTE, Detroit Edison, some Consumers Power, and one other, fairly local utility, and it really was put it in the desk drawer, Dad, and don't worry about it. And of course Ken kept track of everything, but but it really was a matter of this should just chunk out what you need on a regular basis. So it's kind of a neat thing. Plus, I was talking to my mother-in-law about this, 80-year-old mother-in-law, and she's like, that's kind of an interesting thing to take, a piece of this nest egg and then not have to worry, because you could literally in today's environment set it up that brokerage account at E-Trade or whatever actually did auto bill pay.
Yep, would pay the bill once a month. Yeah.
And you would basically never even know it.
Yeah.
Interesting.
It's extremely interesting, and it's interesting for me, Mark, even in the position that I'm sitting in right now with a lot of capital that I can't put to work as aggressively as I would want to anymore, and at the same time, I'd like to have it pulling its own weight in a couple places, and that would certainly be pulling its own weight then. Yeah.
Yeah, and we'll move on, but this is so tangible to me. You basically have this fairly safely invested, there are no guarantees, but fairly safely invested nest egg, which should behave fairly well, actually doing this utility, no pun intended, function of paying this specific bill. So it's good fun and a good way to think about investing potential. All right. Nick DiVirgilio wanted us to talk about, he wants to know what companies are in the small slice. This is the company we put out showing the companies in the Value Line Investment Survey by their buy, hold, or sell zoning that we talked about a couple of weeks ago. And this just simply confirms it's hard to find a stock in the buy zone these days. There's quite a few in the hold, and there's a heck of a lot more in the sell than we're accustomed to seeing. I will say that that's full of a bunch of lower quality companies. Those have actually run up quite a bit, more than they probably deserve to. So there's 71 companies in there. I didn't want to publish all 71. At least I got to keep Nick wanting something. So I stuck with a quality ranking greater than 60. So you're looking at all good and excellent companies. That knocks the number down to 43. And then since I don't have time to look at all 43 of those, I want to look at the ones that have double-digit projected return on value. The math behind the projected return on value is on the upper right. If that's a new concept to you guys, but that's the column that this is sorted by. And it comes out to be, in my opinion, a fairly effective screen. Notice the recent companies that have been appearing on a number of lists, Ken.
Yeah, I'm fascinated that Merck is on this list.
Yep, that caught my attention.
Yeah.
Yeah, Pets is on there, and the three in the middle I kind of discarded because of the lower quality ranking. But Len and I were talking about Emergent Biosolutions, EBS, before we got started. Notice that is the highest number out here. Boy, I hope that's right for the companies that were just selected for our conference panel. Since I did the selecting, but notice that Regeneron's up at the top of this list. iRobot, which I did select for the session, ends up here. And these are some of the companies that have been appearing on a number of lists. I'm going to spend some time with strategic education tonight on the strength of how that looks on this page in all those various categories.
Mark, is this Heartland the asset-based company that I'm familiar with, or am I remembering the ticker incorrectly?
That's the trucking company. I'm 99% sure.
HTLD is a trucking company. Okay, yeah. So it's not the
trucking.
Okay, there's a Heartland Financial, so it must have a slightly different ticker to it.
I'm 99% sure, but I can check that before tonight.
Yeah. Okay.
Yeah, just a little bit low on that. Plus, Morningstar had a different opinion, so I'd rather not fight with them. So anyhow, some interesting companies that come up on the list. And then as we did last week, here's just 5 companies. I put this in the category of chumming. Again, you're doing the serious fishing off the side, but then you've got that idle fishing pole that just might catch something off the back of the boat. That's what this is. You're looking at companies that have that low relative strength index, which means they could be horrifically punished and potentially way oversold. And it's interesting that New Oriental Education ends up on there with a lot of interesting characteristics. That's a company I've never been able to warm up to, Ken, but it's been near the top of screening results for quite some time. There's another company that's in the same field as Strategic, but again, just you never know what you might end up with when you chum. You might need a bigger boat if you do it properly, but just 5 ideas just in case one of them triggers. Nothing jumps out at me there this week. All right. With that, looks like Time for Roxy to go for a walk. Here's a reminder that we actually archive all of these sessions at YouTube under Manifest Investing. You can find all the sessions from the conference last week right there, including the stock panel. Hi, Roxy. And the 2 previous conferences, along with any roundtable and bull sessions that we've done in the past. So with that, I'll just leave you with a picture of a grandpa or two. And there's those bare legs going down the slide, Ken. Slide down the slide. Hopefully it wasn't too hot. But that is our grandson Lincoln showing me how to do it. And sometimes grandsons and sons can show grandparents how to do things. And sometimes it's just the Socratic method panning out. And the pictures on the right are Ken Janke with his 2 grandchildren, a couple of my favorite grandparent pictures that I've run into over the years. And that's Ken actually trick-or-treating in the suburbs of Chicago with Lily on the lower right. So with that, Ken,
Lincoln looks like he has some very serious thoughts that he's sharing with you, Mark.
he has a lot of profound, serious thoughts. He still does to this day. Good, clean fun. All right. So with that, I think we will go ahead and sign off a few minutes early, keeping it brief on our Roundtable Tuesday. Any other questions or comments, Ken?
No, but we will take a couple of questions after we close the recording down. We just have a few, okay?
Okay. I'll go ahead and shut it off. Thanks, everybody. Hope to see you tonight or next week or both. Thanks, everybody.